Although we've had to deal with some unique circumstances over the last couple of years with interest rates increasing and rents actually decreasing, which doesn't happen often, what's really exciting is that the appraisals show the gradual decrease over the last couple of years in rent, and they're actually showing an increased amount of rent projected for 26, 27, and 28. So over the last 2-3 years, nobody's building relative to the number of people that we're building. And so when nobody builds, it means there's less for a prospective tenant to pick from, which means rents can now go back to where they used to be. What's really great about that is these third-party appraisers are showing it's projected that we will be seeing more increased rent throughout the Midwest. So for years, they've been speaking about pretty soon we'll have decreased interest rates. And it was really hard to understand when that would happen. And it would happen maybe at a quarter point, but then all of a sudden it would just kind of stay stagnated. And it's been a little stressful over the last 3 or 4 years for an investor, of course. Well, that's actually happening now. The rates are actually coming down. And the most important thing from the investment side is when they announce a federal decrease in the rate, that doesn't always mean that if you go out and buy an apartment, your interest rate on that purchase will be lower. They're actually, although correlated, they're not always causal. It's not always a mirrored image. And the good thing is we've seen a drop and a decrease in interest rates on things we're buying almost to a full point. Now that'll vary per market. Some markets are a little more expensive because it's smaller. But we're seeing it live out. It's not us anymore saying, well, what's the Fed going to announce and how will that affect us? We are getting bids today showing us rates are lower, which is fantastic because now the reality will match what the owners are trying to sell their assets for, so we can actually buy some assets and build better investments for our investors.
One of the biggest opportunities we are seeing now is the people that had purchased those assets, they've seen a total loss of equity. They're needing to get out from under these properties. So right now we're seeing a lot of deals come in with people approaching their 5-year balloon. We're able to purchase these at honestly pre-2020 pricing.
The interesting thing about supply and demand is as operators, we have to be tied into those sub-markets and how they're operating. For example, if there is a city that extended a bunch of build permits for new multifamily, that could impact how we're able to increase rent. So we have to be tied into those dynamics in a unique way and understand what's in front of us. And we have to prepare accordingly and adjust our business plan based on some of those supply-demand metrics. That's why it's critical in working with knowledgeable, reputable operators that can foresee that, kind of get ahead of the curve and operate effectively. The beautiful thing about what we're seeing about the market dynamics now is we're seeing a boom in deal flow, kind of like we saw back in 2013, 2015, 2016. The reason we're seeing that is as the market cycles, as you exit a low interest rate environment, people oftentimes take out 5-7-year ARMs. When they do that, at the time that those ARMs are up, they have to balloon themselves out and refinance. That's where the metal is tested. As an operator, if you can't make a deal work in that low interest rate environment and all of a sudden you have to refinance to a higher rate, a lot of people are selling off those assets because they can't execute their business plan. What happens is either they're selling them, they're very motivated sellers trying to offload that asset. Well, that's to our advantage because we get those properties at a discount. Brent Village, for example, we built $2.4 million in equity at the day of close because of a situation like that. There were motivated sellers. Additionally, as banks take over some of these assets from those previous owners, they're looking to sell to experienced operators, and that's where we sit. Our relationships are great all throughout the Midwest with brokers and bankers. So we know and understand that environment incredibly well, which means we don't have to compete for those off-market deals. And typically they're those motivated sellers or where that equity can be built day one.
Although it sounds great when the Fed's reducing interest rates, it doesn't mean in actuality or practicality that the lender is going to be reducing interest rates. You can't be underwriting for assuming that interest rates are going to be lowering. Key piece and a key fundamental is creating a strong operational backbone. because during these times when you can't control the interest rates, it's really market dependent. You just have to become a better operator. Our goal, still being value-add investors, is we can go in, we can increase the rents, reduce expenses, so that at a future point, the property's value has increased enough that at a refinance or a sale, we can pay them back their original note.
As an investor, you can take advantage of LeavenWealth's relationships and continue to build that equity and build your passive portfolio.